In this video, I'm going to cover the problem on error correction from the lesson today. I did not get to this part of the lesson, so I'm going to cover it now. With error correction, essentially what has happened is that someone in the past has made an error, and you, for instance, have not discovered the error until the next year, 2 years from now, 3 years later, 4 years later, whatever it is, right? It's sometime in the future. If you discovered the error in the same year in which it was made, you would just fix it. So let's give you an example. So let's say this year, somebody did this. They had a sale to a customer, and the customer paid cash, but the person entering the transaction entered it as a credit sale. So let's just say it was a $300 sale, and they entered it as debit accounts receivable credit sales, and it was a cash sale, so this is incorrect. Now, also this year, you find out about it. Maybe it's, a couple of months later, a couple of days later, it doesn't matter. At some point within the same year, you figure out what had happened. Now, when I do error corrections, I basically do them in 3 steps. Step 1 is to figure out what the other person did. In other words, what error did they make? Now, here in my example, I just tell you, they debited accounts receivable and credited sales. That may not always be obvious. Sometimes you have to think about it a little bit, but you got to figure out what they did. If you don't know what they did, how can you correct it? Right? If you don't even know what the mistake was. First thing you got to do is figure out what they did and know that, okay, that's a mistake. So in this one, I see they debited accounts receivable, but the customer paid cash. So this should not be debit accounts receivable. This should be debit cash. So step 2, figure out what they should have done. So what should they have done? Well, they should have done this year. They should have done this. They should have done cash 300 and sales 300. So the sales part was correct, right? I mean, they credited sales and they were supposed to. The problem is they put $300 in accounts receivable when they should not have. They should have put it in cash. So step 1, figure out what they did. Step 2, figure out what they should have done. And then step 3, correct the error. And so to correct the error, I'm going to need to think about this a little bit. So what did they do? They put money into accounts receivable when they should not have. So the first part of correcting the error is to take the money out of accounts receivable because they shouldn't have put it in there in the first place. And they should have put the money in cash, and they didn't. So the correction is to put $300 in cash, which is what they should have done, and to take the money out of accounts receivable, which is where they put it when they should not have put it. And so that is the correction for the journal entry you would make. So again, the way I think about it is I have to be a little bit of a detective and figure out what they did, then figure out what they should have done, and then make the fix. Okay. Sometimes it's helpful to draw T accounts, draw the T accounts of what they did, and then draw the T accounts of what they should have done, and then figure out what to do to make the T accounts match. So this problem over here on the left side of your screen is also in Blackboard. So if you wanted to go down and if you wanted to go download that as a separate document so that you could blow it up and maybe, look at it on a different page than what I have it. It might be a little small as it stands, but it's on Blackboard. You can go grab it and then work along if you wish. Now, in the problem on Blackboard, which I have on the screen, it's a little bit different. So company C purchased a building 5 years ago and used the following data. And they're basically using depreciation, which we talked about in class on how to do straight line depreciation. Now it says they bought it 5 years ago. So at the beginning of the current year, the new accountant just hired, maybe you, discovered that the previous accountant had failed to include the salvage value in the computation of depreciation. Well, that's an error. I mean, when you do the depreciation, the straight line method, you're supposed to include the salvage value. So the old accountant, maybe that's why they were fired, if they were fired. They're making lots of errors. They didn't put the salvage value in. Well, you've got to. So they didn't do it. So that's a mistake. Now, they didn't do it for the last 5 years. So let's figure out what they did. So step one, I'm going to erase this and start over. So step one, what did they do? They did their straight line depreciation calculation as follows. They did the cost of $500,000 and they divided by the estimated life of 20 years. Notice in the problem there's a salvage value of $100,000. But the problem also clearly says that the old accountant didn't do that. Okay, so they did straight line depreciation of 500,000 divided by 20 years. So they had depreciation of 25,000 per year. So what were they doing? They were debiting depreciation expense for 25,000 and they were crediting accumulated depreciation for 25,000. And they did this for 5 years in a row. Now, I'm assuming that they debited depreciation expense and credited accumulated depreciation correctly because the problem doesn't say that they messed up the debit and credit. It just says that they failed to put a number into the calculation that they should have. So this is a mathematical error, not a I used the wrong account error, which is, when my earlier example, I was using the wrong account. In this one, I've got an error where somebody's just making a math error, right? So you can't assume that they, used the wrong account. You can't assume they debited cash and credited accumulated depreciation because nothing in the problem suggests that. So again, don't overthink it. Don't start looking for things that aren't there. So what should they have done? So step two. What should they have done is they should have done this calculation. I'm just going to copy it and move it down here. They should have done 500,000 minus 100,000. So they should have taken the cost of 500,000, subtracted the salvage value of 100,000, and then divided by 20 years. Now, when you do that, they should have done 20,000 a year. And so what they should have done was to do this journal entry. They should have debited depreciation expense and credited accumulated depreciation 5 years in a row for 20,000. So if we think about this, we can see that the error here is that they put too much money into depreciation expense and too much money into accumulated depreciation. The accountant was putting 25,000 a year instead of 20. So the error was the former accountant put $5,000 too much into depreciation expense each year. And this was for 5 years. It's a struggle. It's a struggle. Okay. So the total error was 25,000 too much into depreciation expense and accumulated depreciation. Okay, so both of those accounts are too big. The total error was the old accountant, the former accountant, put $25,000 too much into depreciation expense over the course of the 5 years. So $5,000 extra every year for 5 years is a $25,000 error. Okay. Now, we're not asked in this problem to do the journal entry to fix it. Okay. You can think about what that journal entry could be, and you can email me about it if you like, but I'm going to move on and answer the question. So the question over here on the left says the required piece is to prepare a retained earnings statement for the company. Okay. So let's do a statement of retained earnings. And we're going to start with the beginning balance of, it says it's $875,000. Now, when we make this correction, and we're going to have to correct it, the correction is going to have to go through depreciation expense because the depreciation expense account is wrong. It's off by $25,000. But here's the hair in the soup, so to speak. Yes, the accountant put $5,000 too much in depreciation expense for each of the last 5 years. But at the end of each of those 5 years, this accountant would have closed depreciation expense to income summary. Because at the end of the year, you close all the revenue and expense accounts and dividends and gains and losses. But you close all revenue and expense accounts and gains and losses to income summary. Why? Because all of those accounts are on the income statement. And where does all that money go? To retained earnings. So if you're going to make a correction to a revenue or an expense account, in a situation where the error was made in a previous year, then the correction must be made through retained earnings. You cannot make the correction to this year's depreciation expense because that would violate the matching principle. If the error to a revenue or expense or a gain or a loss account occurred in a prior year, you have to go back to the prior year to make the correction. The problem is when it comes to revenues, expenses, gains, and losses, that all of those accounts from prior years have been closed to income summary because they're part of the income statement. Therefore, when you want to go back in time and change a revenue expense account or a gain or a loss, it must be done through retained earnings. So you're going to have another line here after the beginning balance, and this is going to be called adjustment. And this is going to be called a prior period adjustment. So, prior period adjustment. Push that down here a little bit. PPA stands for prior period adjustment. In other words, you're making an adjustment from a number that was reported in the prior period, but you cannot adjust the account directly because it was closed in a prior period. Notice this is not a problem for accumulated depreciation. Accumulated depreciation is on the balance sheet, so I can just go fix it. I mean, I can make a journal entry to fix it. That's not a problem. But when I'm dealing with expense and revenue accounts and gains and losses, the adjustments for prior periods have to go through the statement of retained earnings. Now here's where it gets a little nasty, as we talked about when I did this lesson in class. Anytime we're messing with income from a prior period, it has to be net of tax, because net income is a post-tax number, and net income is what is added to retained earnings. Therefore, when I'm messing with income from a prior period, it must be reported net of tax as the adjustment. What makes this problem a little tricky is that depreciation expense, follow me down here, depreciation expense is a pre-tax number. That's what makes this problem different and a little bit tricky. Depreciation expense is an operating expense on the income statement. That means it appears before income tax expense. That makes it a pre-tax number, but the prior period adjustment has to be net of tax. Now, the first step we have to do then is to figure out what net of tax is. I know the total amount of the error. The total amount of the error is right here. It's $25,000, but that's a pre-tax number. So I have to get my calculator, and we're assuming a 30% tax rate. It says over in the problem on the left-hand side that the tax rate is 30%. So what I'm going to do now is I'm going to multiply 25,000 times 70%, because if I'm paying 30% tax, the net, or what I get, is 70%, and that's going to be 17,500. So again, this number right here is 25,000 times 70%. Or if you wanted to, you could take 25,000 times 30%. That would give you $7,500 in tax. And then you take the 25,000 minus the $7,500 and you get to 17,500. Now the question is do you add this or subtract it? And this is where you've got to be careful. The error, follow my logic, and you can rewind this and replay it if you need to. The error is that the former accountant put too much depreciation expense onto the books. Now follow me. If you put too much depreciation expense on the books, then the correction is you're going to need to reduce depreciation expense in order to make it correct. If you got too much in there, the correction is to take it out. If you don't have enough in there, the correction is to add a little more, right? If the error was you put too little into the account, the correction would be to add a little more. Like if I'm making eggs for breakfast on the stove and I taste the eggs while I'm making them and I find out, man, I don't have enough salt in here. Well, the correction is to add a little more salt, right? I mean, if it's not right, you add a little more. So in this case, that's not the case. In this case, the error is there's too much depreciation expense. So the correction is to take some out. Now, when I say that, some of you are going to think that this is a subtraction, but you would be wrong. And here's why. Yes, the error was that you put too much depreciation, the former accountant, not you. The former accountant put too much depreciation expense into the records. So the correction would be to take some depreciation expense out, specifically 25,000 out. But follow this. When you take depreciation expense out, you make it lower. And if expenses become lower, what happens to income? Income goes up. So the adjustment here is not a subtraction. The adjustment here is an addition, because the corrective for this situation is to reduce depreciation expense in the prior periods by 25,000. But when you reduce an expense, it causes profits to be higher. And it's the profits, the net income, that goes into retained earnings. So income has to come up by 25,000, but that's a pre-tax number. So you got to make it net of tax at 17,500. Now we'll let this roll. This will be beginning balance adjusted for retained earnings. And this will be 892.5 because we're adding them together. And then we just add the net income. For the current period over here, it says it's 300,000, so we'll put that in. That's no worries. Let's just line it up here, make it look at least halfway decent. And then we'll less out the dividends. And the dividends were 225, so we'll go ahead and knock that out. And then we'll have ending balance and retained earnings, no worries. And the ending balance here, let me do my calculator. It's 892.5 plus 75 is what that nets out to. So 967.5. And we'll double underline that just to make it look pretty. There we go. So the big thing for you guys is to really think through error corrections that involve income statement accounts, because you have two issues. The first issue is it has to be net of tax, and if you're inside the income statement itself, those numbers are pre-tax because you're not down to tax expense yet. The second issue is you can't simply think of the correction in terms of how it's affecting the account that you're using, in this case, depreciation expense. But you must think in terms of how that error in that account affects net income, because it's net income that goes into retained earnings. Again, that may have been complicated, I know. Feel free, though, to replay this, because it's one of the benefits of having this online, is you can rewind it and replay it to your heart's content. Try the practice problems that are online and let me know if you have any questions.